So the first thing we did is identify the key players. We start with Courtney McBride, the CIO, the two fund managers, Liam Spotswood and Craig Newbridge. Craig also has an assistant CFA level 1 candidate that we thought should be included. So we start by recognizing the undue shift in strategy on Spotswood's end. Spotswood essentially was investing in blue chip, large cap dividend paying stocks. Also, he's managing an equity income fund, which sort of implies that he's investing in large cap dividend paying stocks. But he decides to shift a good portion of the fund into unlisted, smaller cap, growth in nature stocks. He also failed to disclose those changes in the strategy to the clients, and by investing in those unlisted stocks, he decreased the liquidity of the fund and thereby increased risk, again without disclosing those changes. So the standards he violated here was suitability, specifically around managing to the mandate of the fund, not sticking to that strategy. Also failed to communicate this with clients, and we believe clients should be the prime interest here in accordance with their investment goals. What he could have done is maintain the fund mandate, not change anything at all, and just kind of eat the unrealized losses over time. He could also establish a new fund that would essentially complement the current strategy, and he could communicate the associated risks to clients so they understand how that impacts their investment goals.
Yeah, coming to the next conversation Spotswood has with McBride, he agrees to give preferential treatment to one of their clients, and also he proposed gating of the fund. So this clearly violates the standard 3B, which is fair dealing, which says that to deal fairly with all the clients and all their actions and activities. So when Spotswood allowed 10 County Pension Fund to withdraw their investment even before announcing gating of the fund, we say that it clearly violates the code of ethics here. So when I say gating, it means that they are allowing they are restricting their investors in the fund to withdraw their investment for a certain period of time to safeguard all the investors in the fund from a potential risk. Here we see a liquidity crunch in the fund, so which is why Spotswood might have suggested gating here. So we also see that there is a possible violation of knowledge of law if the gating provision itself is never mentioned in the mandates or the prospectus of the fund. So to address these issues, we suggest certain resolutions, which we say that the fund managers should ideally communicate the gating or announce the gating of the fund to all of their clients and make sure that they are aware of the reasoning and the benefits they would get even if they are invested in the fund, and make sure that this aligns with their investment goals in the long run of the fund. We also say that they should give the discretion to investors to take their actions after announcing the gating. Thank you. Going to the next conversation.
So coming to the other side of the conversation, CFA member Craig Newbridge and Sarah Markle, CFA candidate Sarah Markle, engaged into contacting clients before resigning. They transferred the client data from the previous employer. They got the clients to sign on blank forms and then ended up altering those those signed client forms later on, and they inputted standard client profiles across all clients into the new system. This in turn led to a couple of standards getting violated, specifically coming to loyalty, because they contacted clients before resigning. They engaged into misconduct when they transferred out client data without the prior permission of the previous employer. They also engaged into misconduct when they altered the signed blank forms which is as good as deceit or fraud, and they violated suitability when they entered standard client profiles across all clients into the system. And specifically, Craig Newbridge violated the standard of responsibilities of supervisors because he did not he did not direct Sarah Markle to engage into the right actions. To resolve this, we suggest that they communicate a contingency plan at the very start, initial client onboarding. They could speak with the clients at the initial client onboarding by telling them that they could connect over LinkedIn, platforms like LinkedIn, and this would help the clients know where the fund manager is moving to the new profile, new firm, and while doing this, they should also mention that they cannot contact the clients directly when they're moving out of one firm to the other firm. The clients could contact them by seeing the posts on these platforms of LinkedIn, like when they post the new office numbers on these platforms. We also cite out that Sam, the previous employer, is in violation of preservation of confidentiality because he does not it does not have any specific security policies over data governance, and it does not have any specific procedures over employee management. And to resolve this, this in turn led to Craig Newbridge and Sarah Markle taking away the data to the new employer. To resolve this, we suggest that Sam implements stronger data oversight and to manage the data governance and formulate better employee resignation policies.
Now we look at the conversation between Newbridge and McBride relating to the transactions of Fortescue Capital. Fortescue Capital offers to invest $10 million in Locandi's Unicorn Fund if they're allowed 3 round-trip trades in Locandi's New Horizon Fund. Now, the very act of accepting this transaction, Newbridge and McBride accord preferential treatment to Fortescue, whereby violating the standard on fair dealing. Now, the Locandi's New Horizon Fund prospectus clearly defines what abusive trading is and prohibits any investor from proceeding with such trades. McBride chooses to interpret it to their advantage that this is applicable only for individual investors and not institutional investors, contrary to the language in the prospectus, and also decides to withhold this information from the other clients of the fund. This is in clear violation of the standard on suitability, which says the fund needs to be managed as per the specific mandate. Now moving on, given that Fortescue Capital is a large and influential hedge fund, and that the $10 million that they invested in the Unicorn Fund gives the fund an advantage in terms of market visibility, McBride and Newbridge have found themselves in a position that they do not want to reject the round-trip trades that Fortescue wants in the New Horizon Fund, whereby they violate the standard on professionalism, which talks about independence and objectivity. Now, given that we know the violations, where we go from here, as a first, Fortescue should be communicated that the round-trip trades are in violation of the fund mandate and hence cannot be allowed to continue. Then Locandi should conduct a comprehensive review of all their compliances with the fund mandates, document their findings, along with actions for correcting the deviations, and all these should be communicated to the clients. And the action plan will actually help improve the client confidence on the fund. And in order to reduce their reliance on Fortescue, if Fortescue were to withdraw the $10 million, they can engage in other marketing practices like hiring a wholesaler or and work on improving the AUM of the Unicorn Fund.
Okay, so in this slide, we will dive more into the supervisory neglect of Courtney McBride. So we categorize our actions into 3 key points, which are in direct violation of standard 4C, responsibility of supervisors. So Courtney McBride has neglected her supervisory responsibility by failing to guide Spotswood in disclosing the change in strategy to the clients, and it also suggested preferential treatment more than once. And also, McBride has encouraged misconduct in her team by allowing pre-signed forms and incorrect client information. So, to address these resolutions, we suggest that establish best practices, having like a standard template for periodical disclosures to clients, enhancing their communication. And also we suggest periodical update in key documents like prospectus and for transparency. And lastly, we suggest providing ongoing training and education to employees of Locandi Capital so that they enhance understanding of ethical conduct and improve regulatory compliance. Thank you. We are open to any questions.
I guess with McBride, are you all insinuating, I guess in that last slide, that that's a violation across like all conversations?
Yeah.
Absolutely. Okay. And what relation or responsibility does she share in with the relationship with Tink County, the pension fund? What would you say responsibilities that she shares in some of the violations you outlined for that?
So we would say that the first violation comes under McBride because she is the one who suggested the 10 county pension fund to be allowed to withdraw their investment before the gating fund. So I think first the McBride would be liable for supervisory and also violating the standard 3B, which says she is not dealing fairly with all their clients.
Can we go back to the slide about the investment strategy change,
Mhm.
the first part? So in here, you address, or you basically recommend just, or, maintain the fund mandate, establish a new fund. But going back to the story, do you think that, what Spotswood did is, concerns misrepresentation, or do you think there's any misconduct?
That's a good question. I think that when dealing with the asset swap itself, I think that there was a loophole there that they could actually do. But I think when it comes to suitability, is changing the investment strategy from the original mandate was the key focus there. As far as misconduct, you could allude misconduct to having those unlisted stocks through the asset swap portray the image that the fund is more liquid than what it is, especially when he started listing them on the international stock exchange. So I could see where misconduct may allude to that.
Did you all notice any violations, I guess, with the 10% limit, that he was trying to artificially stay below?
Yeah, he tried.
Or what did you highlight there, Kevin, in your slides?
No, yeah, we've gone through when we gone through the case, we identified that they have tried to make their way around the 10% threshold for their investment in the small stock companies, but there is a possibility that they have did that only to stay below the 10% holdings in these companies. But we say that if they have communicated this with their clients before going into these situations, then it would not be the case where they would land up in that situation. And the 10% they have did it purely finding the loophole in the system where they could have taken advantage of it.
So when we dug into the case, we actually went to see if there are any laws or legal actions that could have been coming towards their way when they're violating this 10% threshold, because it says that if they do not stick to if they do not consider the asset swaps, it's going beyond 10% to 16%. But we could not find any specific any specific law or regulation prohibiting this. It is kind of a gray area where we can have a debate on whether it's a violation or not.
Considering those standards as to concentration in any particular asset class,
Right.
or size of position as it affects the overall portfolio, those existing clients before the new ones came over with the new team, and performance of the overall portfolio, was there any analysis done as to material impact, negative impact on pre-existing shareholders?
So I would like to ask, I didn't get the question properly, I guess. Like, you mean when they have used the staying under the 10% rule, they have tried to, then they should have, if that is the case, then they should have let the other funds, investors also know that this is happening in the Lokandi Equity Capital Fund before doing the asset and swap. Is that the question you're trying to answer?
Well, I'm perhaps greater explanation from me. Let's say I'm an existing shareholder.
That's
time. Oh. We'll talk again.